A question or situation I get asked a lot is, why can't my corporation own or lease a vehicle and all the expenses be used in the corporation as a tax deduction? I'm then told of examples of where people did just that, bought, leased new SUVs through their corporation, and the accountant wrote it all off as an expense. Is that true? Can this be done? Well, the answer is yes, of course it can be done, and sometimes it is, but should it be done? Well, not exactly the way it's been described in the question. There are a lot of details and options missing from the cover question. It's a little more complex than that. As an independent operator, it's a minefield. If someone does do it, they expose themselves to a lot of risks and potential costs in reassessment. I don't do it. It's not worth it. Oftentimes, it's just taking money from one pocket and putting it into another, and sometimes the other pocket isn't even yours. I also know accountants who imply they write everything off to their clients, but actually don't, because they know the risks involved. Let's look at this issue slowly, step by step, with a little more clarity and focus. Personal travel, specifically going to and from work, is a personal expense paid for by personal after-tax money and cannot be used to reduce taxes in any way. The Income Tax Act is very clear on that. However, if you have a business and you use a vehicle to produce income for it, the business can and should write off all the expenses for that vehicle. If a business owns or leases a vehicle that is 100% written off, an auditor will need to be assured that it was 100% used for business and 0% personal. In this situation, usually the first question from an auditor is, do you have a personal vehicle? The reasonable assumption is everyone needs a vehicle for personal travel. If you don't have a personal vehicle and you operate a corporation that owns or leases a vehicle, then the assumption is the 100% business use is not 100%. You must reasonably prove you didn't use the corporate vehicle personally. This is going to be difficult. If you do have a personal vehicle and your corporation owns leases a business vehicle, it still doesn't remove all doubt, at least not yet. You have to prove you didn't even have emergency access to that vehicle. Otherwise, you qualify for what's called standby charges. We'll get back to that shortly. The above situation was an example of 100% and 0% usage. But what if you have a corporate vehicle that is used partially for business and partially for personal? How much of the expenses can you use as a deduction? Whenever a vehicle is used for both business and personal, the respective usage must be separated. There are two systems for doing that, one detailed and one simplified. Let's look at the detailed first. The detailed system is receipt and invoice dependent. That means you need a copy of all expenses associated with that vehicle over the entire year. Fuel, oil, maintenance, insurance, licensing, lease expense, or depreciation and interest costs. If you misplace one receipt, you are out of luck for that amount. Paper, paper, paper. No receipt, no deduction. Secondly, and most important, a detailed logbook must be kept that splits the annual kilometers into both personal and business kilometers. This logbook shows annual beginning odometer, the date, the reason for the usage of the vehicle, the beginning odometer, ending odometer, and the ending annual odometer. All necessary. The two figures are then calculated as a percentage of the whole. Let's use a simple example. 4,000 kilometers are business, 12,000 kilometers is personal. So it's 25% business and 75% personal. The personal percentage is then multiplied against the total annual cost of operating the vehicle and removed from expenses. The business amount will remain as a deduction in the corporation along with the respective GST, HST input tax credits. However, the personal amount is the amount you owe the corporation for using the corporation's vehicle. You either pay it in cash, it's added to your shareholder loan, or it's added to your T4 as a taxable benefit, or some combination of all three. We call this system the detailed logbook method because there's a lot of detailed paperwork and record keeping required. If you want to expense it, you got to document everything. If your corporation owns or leases the vehicle, the corporation must be registered as the owner or leasee. Usually the insurance on a corporate vehicle is more expensive than when it's registered as a personal vehicle. If you can even get one insured as a corporation, sometimes it's not as easy as personal. It doesn't matter if the business is self-employed or a corporation owns the vehicle. A detailed logbook will be required by Canada Revenue Agency. Failure by a CRA auditor to require one is not a reflection on the rules and regulations, but a reflection on the auditor. If they are doing their work according to regulations, they will ask for it. Since 80% of operators don't produce a logbook for the personal vehicle, it's often referred to by good auditors as low-hanging fruit. If there is more than one vehicle used in the business, the detailed system will require a logbook and separate invoices for each vehicle. That's a lot of paperwork and a lot of record keeping. Remember, when you lose a receipt or invoice, you lose a tax deduction expense. The detailed method is invoice dependent as well as logbook dependent. If you don't have one or the other, you lose. You pay more taxes. Another thing, auditors will have a lot of information at their disposal. Registration, names, maintenance records, fuel locations, dates, and volumes. They can reconstruct and cross-reference all of it, building a historical blueprint or storyline over the entire year, producing fuel economy, dated locations, and verifications, as well as multiple points of reference. The detailed system is documentation dependent and sensitive. If documentation is provided, it displays a whole realm of additional auditable information. Just because you have a personal vehicle does not mean you are automatically safe to claim 100%. Remember I stated the auditor will need to be assured you didn't have emergency access to that vehicle? Let's deal with that issue. The regulation I'm referring to is called Vehicle Standby Charges, and it assigns taxable benefits that increase your personal taxes. It's a brutal reassessment. The history of this assessment is rooted in the automobile industry, specifically designed for car salesmen or dealerships. Canada Revenue Agency saw that car salesmen were putting the dealer plates on dealership inventory and drive the vehicles home for the night and back again the next day. They would drive a new car for 1 to 4 months. The dealership would turn around and sell that car, and the salesman would transfer the plates to another dealer vehicle, and they would have the free access to that vehicle for the next 1 to 4 months. According to Canada Revenue Agency, that's personal benefit. All the auditor needs to ask is, was that vehicle parked on your driveway one night this last year? If the answer is yes, the vehicle standby charges apply. The calculation is a very long and complicated formula, but simplified, the taxable income added to your T4 is about 1/3 of the market value of the vehicle. So that means a $60,000 vehicle parked on your driveway once in the year would add approximately $20,000 to your taxable income, or about $7,000 in taxes. Imagine a salesman having access to 3 to 6 brand new, highly expensive vehicles per year. That would be $21,000 to $42,000 in taxes. I would not describe that as a benefit. This is an outrageously expensive tax risk that should be avoided at all costs. It's why salesmen typically aren't given that option anymore. If you do see it being done, the dealership is either ignorant or providing some very creative paperwork to track inventory and or assigning their own calculations for a taxable benefit to the salesman's T4 and then defending that to CRA. Most likely, they're ignorant or belligerent. Under audit, they would most likely have to lie like a rug, which is another completely different rabbit hole. The issue can be simplified down to, was the vehicle available for personal access a minimum of 1 day in the year? If so, even if it wasn't used personally, the potential access is enough to qualify for standby charges. It was explained to me like this. If you're home and your child breaks their leg, but your personal vehicle doesn't start, you still had potential access to the corporate vehicle, so it would qualify for standby charges. So, unless you have a 100% company vehicle parked somewhere other than your driveway all the time, every night, it would qualify for standby charges. There is an exemption to this rule, but it's relatively specific. If the employer requires the employee to be on call for emergency service to clients and has regular occasion and systems and documentation for such an event, such as a hydro worker or mechanical service agent, an exemption can be granted. However, an independent operator would not be granted this exemption since the type of work done for revenue is not classified as on call. Remember, if you have a vehicle in your corporation, then there must be a logbook keeping track of the business and personal kilometers. Then the percentages are calculated for each and multiplied against all the vehicle expenses for the year, and the personal amount is added to your T4 as a taxable income. Any applicable GST, HST on the personal kilometers amount is unclaimable as an input tax credit. If you set your business up like this, the risk of standby charges are greatly reduced, but not necessarily totally eliminated. Remember, an auditor has access to all your fuel and maintenance invoices and can dive deep into your blueprint or story and choose to refute your claim. Everything is an open book. The vast majority of all businesses use the detailed system because it is the default method for most accountants. It is used because it has always been used. Very few accountants have taken the time to offer and explain alternatives, especially to independent operators. There is also a very skewed understanding of tax savings provided by using a personal vehicle. Some people think it saves thousands and thousands of dollars annually. National averages for independent operators show personal vehicle expenses to range from $2,400 to $3,000 per year. That represents $800 to $1,000 in taxes. A whole bunch of paperwork and record keeping for only a limited return on investment, and a significant exposure to future audit reassessments. I cannot fathom a situation where I have a company vehicle in my business. There is a reason why some still do it. I'll get back to that reason after I explain the perfect system for you and your corporation. There is a different approach other than the detailed method. There are several names for it, but I call it simplified, and it's way easier. Less paperwork, documentation, and much less points of audit vulnerability. There are advantages and disadvantages and restrictions on using this system as well, but once you use it for a while, you realize how easy it is. First of all, it requires a specific setup, a corporate environment. The corporation must not own the vehicle. It must be owned privately. There must be an employer-employee agreement, and the agreement must be followed, complete with an audit trail. The simplified approach only requires documentation of business travel events, date, reason for the use of the vehicle, and the beginning and ending odometer. The employee is paid a flat rate fee per kilometer, and the payment is classified by Canada Revenue Agency as a non-taxable benefit. The expense is 100% tax deductible for the employer, and even the GST, HST can be factored out and claimed completely for the corporation. It requires no receipts, no documentation, or invoices. Even though it's easier and lower risk under audit, few businesses use it. They simply don't go through the effort and time to utilize its true value. Under most circumstances, there is margin between the allowable reimbursement rates and the average running costs of most vehicles, which means after-tax income. Under this simplified method, CRA audits have only 4 points to verify: date, description, and volume of kilometers. The date is probably the easiest to verify, then the reason, description for the employee using their personal vehicle, and finally the distance traveled to fulfill the description required. The final point to verify is the rate of pay per kilometer. However, if an accountant uses CRA allowable reimbursement rates, an auditor does not contest it, because CRA has had their knuckles rapped pretty hard in court on this point. There is only one technicality that needs to be observed. If you travel more than 5,000 kilometers in 1 year with one vehicle, the rate drops slightly, but you are not restricted to how many different vehicles you can use in a year. If you use 10 vehicles, you can collect maximum rates 10 times 5,000 kilometers. Technically, and this is bizarre, you don't even have to prove the vehicle is yours. Simple, easy, and super low risk. Something just as important as liability is cost. Pulling $1,000 or even $1,500 per month out of an independent operator cash flow while debt is still on the books is not wise. Let's be honest here. Deep down, the reason high-priced vehicles are bought, it's usually a combination of pride and ignorance, more the former than the latter. If you see an operator with really expensive personal vehicles, pity them. I assure you, the level of debt they carry isn't something you want. I know the industry margins. Less than 2% can afford the new vehicle, and those who can afford it usually don't. It's not that you can't do this, but it just makes everything good you're trying to do that much more difficult to achieve. Don't sacrifice your wealth-building opportunity for your ego or pride. I agree with Dave Ramsey, with a few Canadian adjustments. Never own vehicles and toys that total more than 50% of your annual earnings. So that would be an industry maximum of about $30,000 in all personal vehicles, boats, jet skis, everything. Never buy a new vehicle unless you're worth more than $1.5 million in equity. Dave Ramsey uses $1 million in the U.S., but if you want parity with the U.S., a Canadian must be worth 1.5 before they can buy a new vehicle. Otherwise, they become slaves of the automobile industry depreciation cycles. Depreciation is expensive. It is unwise. Do you know what is wise? A debt-free truck, RRSPs, tax-free savings accounts, being mortgage-free. So what system should you use? I suggest the simplified non-taxable benefit method. It has less audit risk and works with non-taxable benefits rather than taxable benefits. It assists you, the operator, in building after-tax wealth, which, according to my understanding, is one of the reasons you became an operator in the first place. Of course, you can design your life the way you want to. It's your choice. I hope you find value in the podcasts we produce. If you like what you hear, share it with a good friend. Have a good trip.